Hey everyone, in this video I wanted to bring you one growth stock down 58% off its high that you might regret not buying on the dip. But as usual, before I reveal this growth stock's name, let me talk about its revenue, its cash flow, its valuation, and then let me tell you the name at the end of the video. So let me get started with the revenue. Looking at this chart, trailing 12-month revenue, you could see explosive growth from this company here, expanding from a little less than 3 billion in revenue pre-pandemic up all the way to 11.36 billion. Now, most of that due to an acquisition, although the company had shown very nice explosive organic revenue growth even before it made that acquisition, boosting its revenue all the way up to 11.36 billion. More importantly, the company's benefiting from this trend from consumers that are just unleashing this pent-up demand for away from home experiences. Now, I've been talking about this in a lot of videos now. In most of the companies that I follow that benefit from this trend, revenue, profits, cash flow have been growing very nicely, and it doesn't look like there is an end to the trend, at least not for 2023. People want to get out of the house, people want to spend time and money outside of the house, and this company poised to benefit from that trend. Another reason why I really like this stock is because it's done a good job turning sales into cash flow. Now, ignore this big dip here, this V shape in the middle, because that was caused by the pandemic. This company, like I mentioned, relies on bringing people together outside of the house in person, and so it was devastated by the pandemic. But look at it before. Right? Look at how nicely it was growing its cash flow from operations. And then, of course, it had that huge crash, but now it's recovering again. Back up to 12.4%, which is respectable. And it's continuing to grow revenue, continuing to grow, expand this cash flow from operations. And given that it's got such excellent prospects in the near term, I wouldn't be surprised if it continues expanding this cash flow from operations to sales metric up to the mid double digits by the end of this year. Finally, the last reason why I think you might regret not getting in on this growth stock right now is because of the relatively inexpensive valuation. It's trading at a forward PE of 19.67, which is right about average for the stocks in the S&P 500. But the company's got really good prospects over the next 4 to 8 to 12 quarters. So I would be willing to pay a premium, slightly premium valuation for this stock, but I'm getting it at an average valuation. So for that reason, I see it as a relative bargain. So what is this stock? This is Caesars Entertainment. Caesars Entertainment, the gaming company that's benefiting as people are looking to get out of the house, and casinos were closed for a big portion of the pandemic, and so people are making up for lost time, getting out, having some good old-fashioned adult entertainment, and Caesars is benefiting from that trend. So I understand if you're an investor that doesn't like to invest in gaming stocks, that's understandable. But if you don't mind that aspect of this company, its financial metrics, its valuation, it's a good value, it's a good risk versus return for this stock here. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.